ICT. Is he a scammer or a profitable trader? By some, considered the creator of the algorithm. By others, considered a scammer. Let's see if his concepts are real or just another guru trying to sell his course. Most people that are in the forest industry have heard of ICT. However, we also know that 90% of traders are also not profitable. Now let's dive deeper into who ICT really is. Michael Huddleston. He claims to be the creator of the trading algorithm. He posts many videos on YouTube since 2018 of price action, his own theory, and the concepts. But these are all blatant lies. All the concepts are copies from other books and old methods that have been around since early times of Wall Street. I will be making another video explaining the ICT concepts and how to use them in the future, so stay tuned. Now we know that he has been participating in trading tournaments. However, he has lost all of them and has breached all the accounts, meaning that he is not a profitable trader and does not know how to trade. However, we can prove that his concepts do work by looking at the charts right now. Alright, so now we're on the charts and I'm going to be giving a brief explanation on how the ICT concepts work. Now, I'm not going to argue about if he copied it or not. We know that he did copy it because it's not his concepts. And by looking at the books from in general about trading, you can find out that these concepts are just copies. However, I'm going to show you that they work and that you can use them and implement that in your trading. And I'm going to first explain the first basic concept of the fair value gap. So the fair value gap, let's say we have a candle here, so let's make it red. It's a bearish candle. We have the wick here, right, like that. So this is just one candle, and then let's make another candle. Just do it like that. Okay, this is a bit too long. There we go. And then we have another candle. There we go. And boom. So now what you see is that you have 3 candles. And we want to look for the fair value gap. The fair value gap is just basically an imbalance. And basically the algorithm will try and go back to the area and fill it to make sure that it can deliver price equally and balanced. So here we have 3 candles in a row. And we want to look at these wicks. So the first candle has a low wick here. So we mark that out like this. So let's make it yellow. We mark that out. Then the second candle is just a body. And then the third candle, we have another wick here. If this wick does not fill this area until this line, that means there's an imbalance. So you mark this out from the top. And there you go. Here you have an imbalance. What will price do? If it's a bearish trend, it will go down, right? But then the price will wick this area like that in hopes of just filling it, and then it'll go down again. Just like that. It'll wick it. And we can look at the price action and see it in the charts. So let's take an example. Okay. So here we have a candle. There we go. And the second candle is the body. So it goes down. It's bearish. Now the other candle here. What do we have? A wick here. So we have a fair value gap. Price goes into this area. If we mark this out, this should be at 50%. See, price almost reaches 50%. So it fills this area and then continues lower. Continues lower, continues lower. And let's take a example that's bullish. Here we have an example here. Boom, boom. Price fills this area twice before continuing higher. So it did that. If we look at it here, another bullish FVG here. It fills this area. There you go. Now also, what can happen is that price disrespects the FVG, which happens. For example, here, boom, boom. Price does go into this area, but it just shoots through it, right? So this is not going to just work alone as a strategy. You have to use the confluences and all the other strategies together, the concepts, to make it work. Now, another concept is the order block. Now, what is an order block? An order block is basically an area where price will tend to reject or break because that order block contains a lot of limit orders from institutional order flow and other areas. So it will look something like this. It would reject as basically like a support or a resistance. So if we look at a chart, we can find order blocks. An order block is right here, for example. It's an order block. Why? Because the price went down, it went up, it went down, it went up, and then it rejected this area. This is an order block. The price should go back. As you can see here, it went down afterwards, but that does happen. Here is another example of an order block. Boom. If you see these candles like that, that's an order block. And you can see here, price fully rejects this area. 1, 2, 3, 4 times. 4 times before making another low here. That's a perfect example of an order block. What else? This could be an order block, but does price go here? Oh yeah, it does. It does go down here. Now this is a bit of a weird order block. If we go on the 5-minute candle, you'll see them on every time frame. Let's see. I'm just trying to find the best example, but you can find them everywhere. You can find here one. There you go. Price taps this area. What else here? Oops. Here, another area. Order block, order block, order block. Now, after order blocks, we also have the redelivered, rebalanced, which is called the RDRB. So essentially, it's another fair value gap, except it's a bit like a hidden fair value gap, and I'll explain it on how it works. So we have those wicks. Let me make that real quick. Okay. So we have those wicks, right? And let's say this is a bearish order flow, and then we don't have an FAG because this candle, this wick, it fully fills this area, so this doesn't have any expansion. There's no point in a fair value gap, right? There's no fair value gap. Doesn't work. But don't forget that if there's a big move where the wick goes down like this or goes up, there's still a gap. It's hidden, but there is a gap. So what you would do is you would take the body, the low of the body like this, and then you would take the third candle's high of the wick. And now this is a RDRB. This is basically a hidden fair value gap. Let's take a look at a 1-hour chart and give you an example. So here, as you can see, let's take an example. You would take this because there's no fair value gap here. There is one, but it's very small, right? So what you would do is you would take this, and then you would take this, right? RDRB. As a RDRB. And then price will go into this area and fill it. However, this is a bullish order flow, so it's going to go up and it's not going to work. It's going to be rejected, right? Another example, let's see. Perfect. Here. The price goes up with a wick. Then the other candle, the third candle, is below this wick. So there is no fair value gap. However, it is hidden. Boom. Boom. What do we see here? Another RDRB. Price fills this area and shoots up. Another area here. Put the wick right here. And then this. What happens? You can see price fills this area. And this happens all the time. This is a hidden fair value gap. Now, obviously, we have many different concepts that I still haven't talked about, and I will be making videos about them later in the future, so stay tuned for that. But that is it for the whole video because I don't want to make it too long and too complicated, so I will make a playlist on the ICT concepts. later in the future, so make sure to subscribe and turn on the notifications and like the video.